Now let's combine the static budget and the flexible budget into the one variance analysis. The actual result may differ from the master budget because the sales and other cost driver level of activity were not the same as originally forecasted. That means that the static budget sales level is usually the different from the actual sales level. So we need to analyze the what is the reason for the variances. Is that from the different sales level, or we want to measure the variances in only focusing on the cost part? So relationship between the static budget variance and flexible budget variance and activity level variance is really important to understand the variance analysis. Actual result and then static result. In the middle, we have the flexible budget. The flexible budget and the static budget has a different activity level. Also, the flexible budget and actual budget has a different the variances in terms of cost. Yeah, because the flexible budget and actual result shares the same level of activity. So the flexible budget variance for the cost of the variance part, and then activity level of variance because of the different level of activity. The sum of these two is the static budget variances. Now let's go to the Excel exercise. Now we combined these two level of activities in the static budget and the 7,000 units in the actual result and the flexible. Again, the flexible budget and actual result are sharing the same the level of units, but the static budget is different. So the reason why we want to create the flexible budget, not staying on the static budget, is that we want to focus on the cost variances, because the sales in the actual result and the sales in the flexible budget is not different. It's not different. Okay. So let's calculate the flexible budget variance and sales activity level variances. So we use ABS function, which is the absolute value between two. And then let's drag it to the down. Okay, let me just fix the design. So we measured those the variances. Also, we want to measure the sales activity level variances. The same way, I just want to copy and paste it here so that we got the variances between the flexible budget for actual sales activity and static budget in the units, the sales, and the variable cost and contribution margin, and fixed cost and operating income. So what is this result, favorable or unfavorable for the variance analysis in the flexible budget? The unit, yes, actually it doesn't matter if we put a favorable or not, because anyway, always the units between number of units between the actual and the flexible budget are the same. And then sales also, it doesn't matter if you put the favorable or nothing on it, that's fine. So let's put just the favorable. And then the variable cost for the actual was 158, but 152, so it is unfavorable. The contribution margin is also now, which is greater. The budget, we expected the margin 64,400, but actual was the 58,000, so it's unfavorable. Fixed cost is greater, $300,000 greater. so unfavorable. The result, now the operating income, do you see? We expected 5,600 negative in 7,000 units, but the operating income now is no longer income. The loss now gets bigger, so it's unfavorable. How about this? The sales activity level variance between static budget and a flexible budget. So the actual units sold is lower than our expectation in the static budget. So unfavorable. How about the sales amount? Automatically unfavorable. And then the variable cost is definitely lower because we expected 9,000 the unit, but the result turns to the 7,000. So automatically the variable cost is favorable, but it is meaningless. That's why we want to compare the flexible budget and the actual result in the same level of activity, 7,000. So this information is more valuable information. Okay, so contribution margin also the reduced from 82,800 static budget to 64, so unfavorable. And the fixed cost doesn't change, so it's just favorable. And then unfavorable because we expected 12,800 the positive the operating income, but the flexible budget under this 7,000 activity level is negative. Now let's collect these variances of the value in order to measure the static budget income variances. Again, the difference between the actual result and the flexible budget is flexible budget variance, and the static budget and between the flexible budget and static budget is activity level variance. And if we combine these two, and then we get the static budget variances between the static budget and the actual budget. So let's put this flexible budget from the calculation. We got it already. And then 18. So this is unfavorable, also unfavorable. So total, the static budget income variances is the sum of these two. So results are unfavorable. But mostly we can identify the cost variances in the same level of activity, which has the more the information, the valuable information. Definitely flexible budget variances in the same level of activities. The variable cost 5,670 has spent more, right? That is the reason to come up with this unfavorable result on the operating income. Okay. Then we can also calculate the sales the activity income variances, the 18,400 a little bit different way. Okay, there we go. The actual sales units. How much is the actual sales of unit? Right, the 7,000. And then actually is now the 7,000. And then the less static sales of budget units. How many units? Right, the 9,000 is the static budget. And then here the budgeted the contribution margin per unit. Budgeted contribution margin per unit is calculated, right? 64,400 divided by 700. Okay, and then we can measure the 2,000 times 9.2 the budgeted contribution margin, so we get the 18,400, which is sales activity income variances. Okay, now see you in the next video clip. Bye bye.